Thank you for watching the webinar. If you have any questions, feel free to call us or visit our website at www.greengrowthcpas.com. Okay, we have people have started joining. So I'm seeing here Nate from Walnut Creek. Nate, welcome to the webinar. Super excited to have you here. Okay, I see Derek is sending over some questions. That's funny. Very funny, Derek.
Hey everybody, it's Marko Glisic with GreenGrowth CPAs, and we're back with the valuation of cannabis businesses part 2. And before we get started, I just want to let you guys know the information contained in this webinar presentation is meant for guidance purposes only and not as professional legal or tax advice. Further, it does not give personalized legal, tax, investment, or any business advice in general. And now that we have that out of the way, let's get started. The agenda for today is we're going to go over the last week's webinar. We're going to go a little bit more into retail business, right? So dispensaries, deliveries, cultivation, a couple of notes when acquiring some of these businesses, and then we'll wrap it up. As far as about GreenGrowth CPAs, so we started off as a tax preparation firm. We've completed over 500 tax returns for all verticals, right? So dispensaries, distribution, cultivation, manufacturing, delivery, and testing. We have over 300 clients based in California, Colorado, Michigan, Oregon, and Washington. We've performed over a dozen audit-related projects in the last year. We expect to hit 7 digits in revenues in our second full business year. And just in general, we bring a deep bench. We have a thorough and deep understanding of tax, compliance, assurance, valuation-related work for cannabis industry. Cannabis is our bread and butter, and that's all we do. To recap the last webinar, so we really covered the 3 common ways to value a company or a group of assets, right? So we said number 1, discounted cash flows, or also known as DCF, guideline public company method, and the guideline transaction method. And again, from our experience, really the best method to understand the value for a cannabis company is a DCF. We also covered what investors should look for in a cannabis company, right? So we said, number 1, it's not a leveraged business, right? It doesn't have a lot of debt that's going to just drag the operations and cash flows, right? The worst thing is when each month, right, or each quarter, or each year, you got to take X amount out of your cash flows to pay the lenders, right? Number 2, if it's a mature business, the better it is, right? It's going to give it a lot more stability, a lot more history, and you can trust management more. Number 3, it has a well-developed sales, distribution, and procurement channels. Number 4, it has a clear history of financial reporting, right? So on a monthly basis, investors and managements are getting those financial reports. They give them an insight into the company and the way it's operating. And number 5, it really has a strong system of internal control, so you can really rely on those numbers, right? Cash reconciliations are done, inventory counts are done, balance sheet recs are done, all the expenses are being approved, there's strong controls over money coming in. Also, another item we covered that again I want to really underline because I think it's really important is kind of the 2 factors that really drive the discounted cash flows, right, or the DCF model is projections, right, / cash flows, and number 2 is the risk, right? So we said the higher the projections are, right, the better the cash flows are, the better the value of a business is. So what I want to do is I want to jump into a DCF model we have here put together, right? So as you can see, there's about 5 years here worth of information, right, of projections, and then we have a terminal period. In the top of the model, what we have are the projections, right? Kind of all the inputs that are really driving the cash flows. And what we have in the bottom is just kind of more the valuation assumptions and the valuation calculations to really get that value, right? So again, everything at the top highlighted blue, business assumptions, right, / projections. Everything down in the pink is more valuation assumptions and calculations. If we kind of start at the top, really what we see is we have our revenues. From revenues, we got our EBITDA. From our EBITDA, then we have change in net working capital, we have capital expenditures, and then we have depreciation and amortization, right? And all these items, adding and subtracting these items is how you get your net cash flows, right? In the end, really what those net cash flows are, it's really the net money that ends up coming into business at the end of the year. So I think what we see here is 109 in year 1, 143 in year 2, 217 in year 3, and et cetera, et cetera. And so the way that things work out, right, is if I ended up increasing the cash flows in year one from 109, let's say, to 209, the fair value would go up. So as you can see, really important part of valuing a company is really just understanding those projections and what's driving them. And kind of what's interesting, when you look at valuation assumptions and calculations, there's some differences as you go from one vertical to the next one. But the biggest differences you see is really with those business assumptions, with projections. The way you're kind of looking at projections for a retail operation versus cultivation operation is going to be a lot different, right? Because you're looking at two different types of businesses and there are different key metrics driving those projections, right? So without further ado, let's jump into the retail projections. So what I have here is just, again, at a very high level and aggregated level, projections for a retail operation, right? It can be a dispensary or delivery, right? So with projections, you always gonna want to start at the top, building up the top line, the revenues. So when you're looking at a retail operation, the two things that are driving it is, number one, we have number of transactions, and two is the average spend per transaction, right? So average spend is whenever a transaction gets ringed up on a register, right? Whenever a customer comes in and spends money, how much does a customer spend on average? Is it 30? Is it 40? Is it 50? Is it 60? And then the higher that number is, the better the projections are going to be, right? The better the top line, the revenues are going to be, and that's going to drive higher cash flows. And same with number of transactions, right? The higher the number of transactions each day, each month, each year, the higher your revenues are going to be, and the higher the cash flows are going to be. Once that revenue number is built up, really then what we have is the cost of goods sold. So really what the dispensary or delivery service pays for the product that then kind of ends up turning around and selling. Kind of the way the dispensary and delivery owners are thinking through this, right? They'll buy a product from a wholesaler, right? And they're going to apply a retail markup to it. They'll say, okay, well, I spent this much for this product, and now let me put a retail markup to it times 1.5, times 2, times 3 to get to my retail prices. And so when you're really looking at the cost of goods sold, you want to work backwards. You're starting off from the revenues, and then you're applying that retail markup to get to the wholesale cost, which again, really what it is cost of goods sold. And again, that retail markup is just going to depend on a lot of things. The product mix, flower versus concentrates versus edibles versus topicals. Again, it's going to depend on the type of brands that are being presented. Are these kind of more top shelf brands, or are they just kind of more regular brands, cost effective brands? So there's going to be a lot of things that kind of go into developing that retail markup number. But again, the higher that retail markup number is, the better the projections are going to be. Because what ends up happening, right, you're going to have a better gross margin, and then from there, the cash flows are going to be better too. Now, once the gross margin is set up, then really what you have is just more kind of your selling, marketing, and overhead type of expenses. So if we start off with marketing, this is a variable cost. You really want to understand what's the relation of that cost to the revenues, right, to the number of transactions. So really, what does it cost this dispensary or delivery to acquire one customer? Is that $2? Is that $5? And kind of what's their method of acquiring that customer, right? Is it more social media, right? Things like Instagram, Facebook? Is it print? Is it PR, right? Or is it more merchandise? Is it weed maps? Again, and every dispensary and a delivery should be keeping track of this, because otherwise you don't really know what's your ROI on marketing, right? And then once you kind of understand the relationship between the marketing cost and revenues, you can also then understand, as the business scales, kind of how that variable cost, that marketing cost, relates to revenues. And really what it should be, if revenues are now, instead of 3 million, if there's 6 million, does it make really sense based on that marketing spend? And then as you kind of look within, you really want to kind of reconcile that marketing budget back to the number of transactions, right? And then within the number of transactions, you really want to understand kind of what's the customer model look like there. Are these recurring customers or are these new customers? Again, a business that has a lot of recurring customers is going to be a lot better business than the one that doesn't have, because it proves that the customers that are coming in are having a great retail experience where they just kind of keep coming back. And so then generally what you can see, and again, it really kind of depends on the way the businesses tackle their marketing, how much they want to scale. But for a business that has achieved a certain level of scale, they're comfortable with it, you can then see that marketing spend going down, right? Because what ends up happening, that the returning customers keep going up, and it's able to kind of sufficiently generate the cash flows and revenues with less of a marketing spend. And then on the other hand, You might have a business that kind of keeps just putting money in because the machine is working. They have a great number of recurring customers. They just keep coming back, and they know as long as they pour money into it, the machine is just going to keep growing. From here, we've pretty much covered all the variable costs. So we looked at kind of the product variable cost, and two is marketing. What we have now is just more fixed type of costs. So payroll, utilities, accounting, software, security, things like that. And really the key with this fixed cost is twofold. One is completeness of the costs. Do the cash flows capture all the costs? And I can't tell you how many times I've looked at projections where those costs are just, it doesn't include everything. There's always something missing. So whenever you're looking at pro formas, at cash flows, at projections of a prospective business you're looking to acquire, always ask for a lot of detail, right? If they give you just kind of like other expenses, kind of these aggregated numbers, always ask for that detail, because there's a big chance that some of these costs are not included in there. And then the second piece is the accuracy of those costs. A lot of businesses will get overly optimistic with the numbers they're reporting there. And now that we kind of have a general understanding of all the key assumptions driving the cash flows, and again, when you look at the pro formas, it really depends that they were built, but for the most part, this is kind of the type of information that should be captured in there. Right now that we have those pro formas and they show kind of what the cash flows are going to be for year 1, year 2, year 4, year 5. Now let's try to get some comfort around them. Let's try to understand, really, do those numbers make sense? And so what we want to do is we want to see if a business has some history of doing business and kind of what the actual numbers are. Then what you can do is you can take those projections and reconcile them back to the actual numbers. So for example, if an average spend in the past has been $30 and now the projections are showing $60. So every time a customer comes in the future, the business is expecting they're going to spend $60 on average, whereas for the past 3 years, they've really just spent $30. That's a big gap that needs to be explained, right? What is it behind that? Is there some sales strategy? Is there some marketing strategy? Same with the average number of transactions. Again, if the average number of transactions in the past have grown at a factor of 10%, and now we're looking at them growing at 50%, right? There's a gap there that needs to be explained. So the question now is, how do you kind of get a better sense of those actuals? How do you, in a sense, do due diligence over them? And so a big source of information is going to be a point of sale system. I see some questions coming in. Please feel free to drop in some more questions. And then if we have some time at the end of presentation, we'll cover those. Or if not, just contact us directly at our website, www.greengrowthcpas.com. In cannabis businesses, in cannabis industry, just by the virtue of being very regulated, point of sale systems are very robust and they capture a lot of good information. So from a good point of sale system, you'll be able to capture average transaction amount, the average spend, the average number of transactions per month. You'll be able to see the returning versus new customers. You'll be able to see the markups. So just through the point of sale system and really doing a extensive due diligence through it, you'll be able to get really good comfort over the revenues and cost of goods sold, right? And then really what you're left with is more kind of below gross margin type of items. So as we're saying, marketing, rent, utilities, payroll, and all that information should be captured in a company's accounting software, right? Whether they're using QuickBooks or they're using Xero. And again, behind, let's say if we're looking at rent, there should be a lease agreement behind it. If we're looking at payroll, there should be payroll runs and payroll data that's capturing the payroll software, right? Whether it's Gusto or ADP or some other provider. Again, security, there are going to be invoices behind it. So again, a really good practice is to go through those, make sure that those fixed monthly costs are accurate, they're not underreported. Also, another item that you can cover by looking at the books is the completeness of expenses. Is there something that's showing up in books as a recurring cost where you see it every single month, but it's not in the projections? And if it's not in projections, again, it's a big gap. What's their explanation? All right, and that pretty much wraps up the retail part of the presentation, and we'll jump into cultivation. So again, with cultivation, as I was saying, the assumptions are going to be a little bit different. The retail and cultivation, it's fundamentally two different type of businesses. One is business to consumer, right, direct to retail. The other one is more business to business. So the metrics and the cost structures for a cultivation business are going to be a lot different. So if we jump to the next slide, what we have here is just, again, more of a high high-level summary of assumptions that go into cultivation operation. So usually you start off with the square footage. And the square footage, a big note here, is that when you're looking at the square footage, don't just look the square footage of entire facility, because it's going to include a lot of other things that are not necessarily directly related to the yields and the harvests. So for example, square footage used for packaging, for parking, for drying. These are the items that won't really have any impact on the yields. So really what you want to look at is the square footage of canopy, of the flowering space. And you can see in this example, we're using 10,000. Then you want to look at the yield. It can be expressed in a lot of different ways. One way we tend to look at it the most is grams per square foot. So this is kind of per 1 square foot of canopy space, how many grams are being yielded each harvest. So in this case, we have 35, but that number can really vary. You know, it can go even up to 60 grams per square foot. And so that's really how we kind of get grams yielded per 1 harvest. And then you're going to apply the number of harvests. And again, that can vary. It can be 4, it can be 5. Maybe it's less. And that's how we can get total grams harvested and total pounds harvested. And from there, you're applying the price per pound to really get to your top line, to your revenues. Once we have our revenues, then really what we're going then more down to is towards cost of goods sold and other expenses. Cost of goods sold is going to be composed of multiple types of items, right? So you're going to have your packaging, your growing supplies, your labor. It's going to be both trimming labor. It's going to be just the growing labor, right? The master grower, the assistant growers. Then there's going to be a lot of utilities involved. So electricity, water, etc. And a lot of these costs are variable. And so it's very, very important to understand the relationship of those costs back to the pounds produced. And depending on what type of grow it is, right? Are we talking about the indoor grow? Is this a greenhouse? Or is this an outdoor grow? It's going to differ a lot. But a good way to kind of evaluate the cost of goods sold number in totality is to look at the cost per pound. So once all those cost of goods sold items are accounted for, what does that cost per pound come out to? Is it 300 per pound? Is it 400? Is it 600? Is it 700? And again, generally what you tend to see is indoor grows have a higher cost per pound because it does take a lot of electricity to run that type of operation, right? And then comes the greenhouse, and then from the really the kind of the most cost effective way of growing is really the outdoor grow, because you're really kind of relying on natural elements to support your grow. And so if we kind of look at the different costs of grows and cost per pound, generally what I see is the indoor grows are the ones that are most expensive, right? And that's because you have a lot of additional costs. Electricity can cost quite a bit. Just the build out of the facility, the depreciation, amortization on that. Then from there, we kind of move more to the mixed grow, right? With greenhouse, where we have some benefits of natural elements and outdoor, but you also still have to spend some money that are related to indoor. And then really kind of the most effective one that you see is the outdoor grow, really where you're relying the most on natural elements to grow the plants. You're still going to have some spend to grow it, labor and nutrients and soil and etc. Once we kind of have now the revenues and cost of goods sold flushed out, really then what you have is operating expenses. And again, this is going to be kind of your selling, marketing, overhead. And again, your selling and marketing for cultivation operation are probably not going to be that significant. In general, a lot of the costs for growing operation do pertain to cost of goods sold. And so again, it's really just a matter of understanding these costs, whether they're completely accounted for and whether they're accurately accounted for. And there's two ways to go about that. You really have to look at the company's books, so at their zero, at their QuickBooks, and a lot of information should be captured in there, right? So, if they're showing 3 million in revenues, we should be able to go back and pull up invoices and cash receipt support to vouch that. If they're showing this cost per pound, right, we should be able to understand how much was spent on labor, right? What did the payroll records show for labor? How much was spent on rent? What did the copies of leases and payment support say for rent? So again, it's very important to vouch all this information, right? If they're showing the yield is 60 grams per square foot, but in the past they've only gotten 20 grams, that's a big gap. That needs to be explained, right? We got to figure out how they're bridging the gap. And you might come across some business opportunities. You've done your due diligence. Some of these metrics look terrible. It looks like this business has a lot of weaknesses versus strengths. That might not be a bad indicator, because now you can bring your skill set and your perspectives and turn this thing around, right? So you may come in, get a good deal in this business, and then turn it around and scale it up. So then what would be like some situations, right? So let's say for a retail operation, that average spend transaction is pretty terrible. A big question is, have their bud tenders had a proper sales training? When a customer comes in, does the bud tender really understand what they're looking for? And is it able to kind of bring them to the product categories that would kind of elicit that higher spend per transaction? Number two, what's the number of transactions is low? Do they have a good social media presence? Are they running daily deals? Do they have any discounts, right? Do they have loyalty programs, right? With a loyalty program, if you get a recurring customer that comes there twice a month, every month, now for just spending very little money in terms of marketing to bring that person through the door, that's going to be a stream of cash flows that's going to support your business for next months or years. So there's a lot of different ways that when you walk into business, you can look at to improve the metrics and bring up those cash flows, which down the road then are going to increase the valuation when you're looking to sell the business. The same thing for cultivation operations. You might look at some of these metrics and the yields look terrible, right? They're yielding 10, 15 grams per square foot, but then they have a great facility. It's very sizable. The location is amazing. It's nestled right kind of where you want it to be, where you can easily distribute the product, right? Distributors can come and pick it up. Well, then it's really just a matter of bringing the yield up. And that can be done through different ways, right? Are the nutrients appropriate? Should the master grower be different? I mean, I've had clients where they've brought in a different master grower and then their yields have doubled, right? And it can be a lot of different things. Maybe the growing methodology doesn't make sense anymore. People have been using it for 20, 30 years and it's antiquated, but there's so much more now new stuff that can be really used to improve the yields. So this wraps up how to kind of look at these two types of businesses, but let me just kind of tie it all for you with key takeaways. So again, we said number one is you got to understand the key assumptions driving these businesses, whether it's for retail, we were saying average spend per transaction, number of transactions, or whether for cultivation, the yields, the grams per square foot. Number two is always make sure you do proper due diligence around those actuals. Look at the point of sale system, look at the payroll systems, look at their books, look at the contracts, look at the invoices. And again, some of this stuff can get pretty complicated and overwhelming. So make sure you get in touch with an expert team that can come in and has a deep understanding of both finance, accounting, and cannabis industry, and can come in and help you with this. Number three is, again, there's a lot of opportunities out there. Some of these deals you come across might look like terrible deals. The companies might look like they're terribly run, but that's where often you'll see the biggest gems. There's a good opportunity for turnaround by bringing your skill set, whether it's bumping up the sales, bumping up the marketing numbers, getting better yields. And again, a big takeaway is always make sure that the business you're looking into is compliant on all the levels, right? Whether it's taxes, right? Federal, state, payroll taxes, excise tax, cultivation tax, sales tax, and also do they have the proper licensing? I mean, you might be walking into a total mess. The business might look great, the projections are great, everything is great, but the basics aren't there. Then you'll be in a position when you're being chased down by the IRS and the federal agencies and the state agencies over regulatory stuff. That concludes the presentation. If you guys have any questions or any help with your particular valuation, please let us know. We'd love to help. The best way to reach us is either through our website, www.greengrowthcpas.com, or call us directly at 800-674-9050. Have a great day and looking forward to talking to you soon.